If you invested $1,000 into NVIDIA stock at the peak in March, you would have $215,011. But that doesn't necessarily mean that NVIDIA is a good investment going forward. To understand what was going on here myself, I hired a financial analyst to do a deep dive on NVIDIA's parabolic rise. And what we've discovered here is absolutely shocking. If you personally own NVIDIA stock or are thinking about buying it, you don't want to miss this video. Now, in addition, this analyst put together a list of 10 stocks that could be big winners in the future, as well as 3 that he has on his watch list. Hundreds of hours went into this research project, as well as a lot of money on my part. So if you enjoy this type of content, please make sure to drop a like as well as subscribe for the YouTube algorithm. Let's start off with NVIDIA and the reasons behind this meteoric rise in the share price. Simply put, tons of companies want to build chatbots as well as AI-enabled solutions, and NVIDIA sells the hardware that makes all of that possible. Its GPUs, which are essential for running advanced artificial intelligence algorithms, have become the industry standard. Now, this rapid scaling up in demand has caused NVIDIA's revenue to skyrocket, but keep in mind that the stock market is forward-looking, and everything has to fall into place perfectly in order for this share price to be sustained. Now, the projected value of the artificial intelligence market is set to hit $305.9 billion in 2024. It's then expected to grow at a compound annual growth rate of about 15.8% between 2024 and 2030. But here's the first reason for concern about NVIDIA's seemingly unsustainable share price. The AI market no doubt saw substantial growth in 2023 with expectations of continued robust growth into 2024. However, that growth rate is expected to decelerate and become far more conservative going into 2025 and beyond. It's the opinion of our analyst that the surge in stock price observed recently is believed to be an emotional response to the latest technology, and it's expected to undergo a correction by 2025. But just how overvalued is NVIDIA at this point in time? You're going to want to buckle up for this because I'm about to blow your mind. The PE ratio is one of the most widely used valuation metrics out there, and it tells you the price investors are willing to pay relative to a company's ability to produce $1 of annual earnings. Now, each industry out there has their own norm relative to growth prospects, and the semiconductor sector has a much higher than average PE ratio when compared to the rest of the market. Right now, the semiconductor sector is valued at a remarkable price to earnings ratio of 62.1, which significantly surpasses the historical 10-year average of that sector, which was 25.2. Our analyst believes this discrepancy highlights a clear misalignment between the growth in stock prices and the growth in earnings and revenue, suggesting deep overvaluation within the semiconductor industry. Simply put, investors broadly are paying more than double what they have in the past 10 years for exposure to $1 of annual earnings from this sector. But here's the crazy part. Even within this massively overvalued sector, NVIDIA still stands out as overvalued. Utilizing the price to sales multiple, which is another popular valuation metric, NVIDIA's pricing is higher than 98% of its competitors who are in the same sector. Our analyst found this to be true across other critical multiples, including price to operating cash flow, price to free cash flow, and price to earnings, which we mentioned already. In order to put a reasonable valuation on NVIDIA, our analyst deployed the discounted cash flow approach, which is a little bit complicated, but let me go ahead and explain this in layman's terms. Remember how we mentioned earlier that the stock market is always forward-looking? Well, the discounted cash flow model allows you to estimate the value of a stock based on predictions about their future cash flows. Now, at the time of his calculation, NVIDIA's stock was trading at $942.98 a share, and based on the anticipated growth of the overall industry, deploying the discounted cash flow model, our analyst believes the intrinsic value of NVIDIA's share price today is about $548.34, which implies overvaluation of about 70%. Overall, this analysis points to a significantly greater potential for loss versus a gain at this point in time with NVIDIA's share price. But here's the crazy part. The analyst pointed out that we have seen this exact scenario play out before, and he has significant correlations here between this and the dot-com bubble. We'll get right into that comparison shortly, but first, a word from our sponsor. Look, we all know the stock market is one of the best wealth-building tools out there, but retail traders are at a disadvantage from day one. That's because the pros on Wall Street have access to tools, data, and capabilities that average retail investors do not ordinarily have access to. So if you're looking to trade like the pros, you need to have access to the same tools. Bloomberg Terminal is what most pros are using, but it costs about $25,000 a year. Well, check out our sponsor, TrendSpider. It's a professional-grade market research and trading terminal, but it's made for everyone and actually affordable. From charting analysis to strategy development, idea generation, and even trade timing, TrendSpider does it all. Personally, my favorite aspect of TrendSpider is all of the alternative market data that I can access with it. This makes finding opportunities in the market much easier than before. Click the link down below because TrendSpider is extending a unique offer to just my audience, and it might not last forever. So jump on this right now by clicking the link in the description below. So how does this broad overvaluation of AI stocks compare to the dot-com bubble? Well, in the words of our analyst, the internet boom brought huge excitement for tech companies, especially those ending in .com. At first, investors were so hyped about this new tech wave that they threw traditional investing rules out the window, betting everything on the next big thing. Stories of incredible stock profits and people getting rich overnight from tech shares fueled FOMO, or a fear of missing out. This, of course, caused everyone else to jump on the bandwagon, sending stock prices sky high. During that time, it was a brand new technology that caused company stock prices to soar, much like what's happening today with semiconductor firms including NVIDIA and Supermicro. Notably, Supermicro recently experienced a pullback of around 25%, signaling a potential cautionary tale and hinting at substantial future price declines. Now, for comparison's sake, here's a few articles from the dot-com bubble that our analyst flagged as a comparison for what's going on today. Dell's rise of more than 200% in share price helped it outperform its competitors. By comparison, Compaq stock rose 90% during the year and Gateway climbed 36%. Investors who held shares in troubled hardware makers Apple Computer and Silicon Graphics were left holding the bag at the end of the year. Shares of Apple dropped about 25% by year's end, while SGI shares fell more than 50%. A number of notable internet companies outperformed the NASDAQ by leaps and bounds this year. America Online, AOL, jumped roughly 146% during the year, and Yahoo soared over 500%. However, we all know how this story turned out. Reality set in as investors began to realize many of these companies were not profitable or even generating revenue in some cases. Many didn't even have a real plan beyond just having a fancy website. The bubble inevitably popped in 2000 and the tech craze came crashing down, leaving investors ravaged. And just to show you how insane this time period was, here's a visual of the PE ratios for many of these companies at the time. In hindsight, it was clear these were significantly overvalued, but it's difficult to be able to see that while the bubble is forming before it actually bursts. After the tech bubble burst, tons of companies found themselves in a bankruptcy situation, including well-known names like AltaVista, Broadcast.com, eToys, and even Netscape. Meanwhile, the companies that managed to stay afloat didn't see their valuations recover to previous levels for 10 to 15 years or more. Can you imagine that? You buy a stock at the wrong time, and assuming the company even stays afloat after the bubble burst, it takes you a decade or even longer to see the share price price come back up to the price that you bought in at. If you take a look at Cisco stock, which was flagged by our analyst, you can see how investors got locked in and had to either take massive losses or ride it out for nearly 20 years. In fact, Cisco stock has never actually reached the price that it was trading at during the peak of the dot-com bubble since then. Now, stocks like Oracle and Microsoft had a similar situation play out, but these did eventually surpass their peak of the bubble share price about 2 decades later. This chart here shows the average 20-year annualized returns by asset class from 1992 to 2011 compared to the average investor. During that time period, the average investor had an annualized return of 2.1%. Meanwhile, inflation came in at 2.6%, so they actually lost money over that 2-decade period. Our analyst also pointed out that we've seen similar bubbles appear in the market since then, including the biotech bubble, the 3D printing craze, the cannabis gold rush, and most recently, the electric vehicle bubble. What's fascinating is they all share a common thread, which is a groundbreaking or disruptive technology. And here's how all of these cycles have played out. First, a new game-changing technology hits the scene. After that, early investors jump in, betting big on the companies leading the charge. And these early bets start paying off with returns that beat the market average. Then come the buzzwords, the headlines, and the success stories, drawing even more people to invest in anything related to the new technology. And at this point, the FOMO or fear of missing out hits, and investors begin to skip their due diligence and invest no matter what. Confidence skyrockets, and across the board, everybody starts to think this time is different. But inevitably, every single time, the mood shifts. Maybe it's the overall economy or a major player in the industry that misses an earnings target. All it takes is one event for the bubble to burst, and very few are going to end up selling at the top. So that's the state of the AI industry right now. But here's the interesting thing. There's a handful of stocks that our analyst identified that have significant growth potential based on their involvement in the artificial intelligence industry. However, they have been largely overlooked because everyone's focusing on the big names. And these particular stocks are not trading in nosebleed valuation territory. It's important to remember here that I am not a financial advisor, and this is not any sort of financial advice or a buy or sell recommendation. You should always do your own due diligence, and this is simply a collection of stocks that you may want to do further research on yourself. With that being said, let's dive in. First on our list, we have Sprinklr, an AI-powered customer experience management platform. Founded in 2009, Sprinklr has emerged as a key player in customer experience management, providing a cloud-based platform that enables enterprises to engage with customers across multiple channels like Facebook, Twitter, and WhatsApp. This company has a global footprint, working with over 1,400 different enterprise customers such as Nike and Microsoft. Sprinklr leverages cutting-edge technologies such as sentiment analysis and natural language processing to deliver personalized customer experiences. Sprinklr recently posted its first profitable year with a net income of $51.4 million and EBITDA of $49.41 million. Regarding the balance sheet, the company demonstrates strong financial health, boasting $656 million in cash and cash equivalents, which notably exceeds its total liabilities of $429 million. The customer service industry is facing massive disruptions from AI, and as more companies lean towards adopting this new technology, Sprinklr stands to benefit massively. Next, we have DocuSign, the global leader in e-signature solutions and a key player in broader digital transaction management. Now, this stock was a big winner during the pandemic, but it became too obvious of a play and became significantly overvalued. Most people are only familiar with their core product, which is DocuSign e-signature, but here's a rundown of their other products. DocuSign CLM is a contract lifecycle management system for the entire contract process, from generation to signing and beyond. Then we have DocuSign Payments. This system collects payments along with signatures, speeding up financial transactions. They also offer DocuSign ClickWrap, which is a digital consent solution for simple agreements to terms of service and things like that. Lastly, we we have DocuSign Notary providing an online notary service. Currently, DocuSign commands the market with an estimated 75% market share, having been a pioneer in electronic signature solutions. In the past, DocuSign struggled with profitability, but the company has improved significantly over the 2024 fiscal year, boasting $73.98 million in net income and $195.59 million in EBITDA. In addition, DocuSign has showed notable balance sheet improvement by reducing its total debt from $888 million to $143 million. Up next, we have the parent company of Google, which is Alphabet. Alphabet boasts innovations in technology, delving also into healthcare, autonomous driving, and more. They also own YouTube, which has become a massively valuable subsidiary. Alphabet boasts an impressive balance sheet, holding approximately $119.94 billion in cash, equivalents, and short-term investments. Its total debt is comparatively low at $29.05 billion. Google Cloud, which competes with Microsoft and Amazon, has achieved a break-even operating margin, experiencing substantial growth that significantly impacts Alphabet's free cash flow, with projections indicating continued positive trends. In addition, Alphabet has also stepped up its share buyback program, potentially mirroring Apple's approach, which will enhance the company's earnings per share and, consequently, its stock price. A lot of people have put Alphabet on the back burner when it comes to comparing them to OpenAI and their ChatGPT product, but it would not be wise to rule them out of the game. Google Gemini may not be a big part of the discussion right now, but I expect that to change in the near future, as Google is not known for simply giving up. In addition, they've also been rapidly rolling out changes to the Google search algorithm to include AI-generated answers at the forefront. Moving on now, we have UiPath, a global leader in robotic process automation, or RPA. This innovative company is transforming the business world by automating the mundane, rule-based tasks usually done by humans. Dubbed the Business Automation Platform, this company is bringing enterprise-level AI solutions to companies big and small. UiPath Studio is a design tool with a drag-and-drop interface for easy bot creation. Then there's UiPath Orchestrator, which manages and monitors bots for secure, efficient automation. UiPath Robots executes automated tasks across different applications. Finally, we have UiPath AI Fabric, which integrates AI, enabling advanced automations like document analysis and computer vision. UiPath, which is often overlooked since its IPO, is nearing profitability and has demonstrated substantial operational enhancements in recent quarters. From a balance sheet perspective, the company maintains a low level of debt while holding substantial cash and equivalents. Perhaps the most interesting part of what they do is the fact that robotic process automation is designed to cut costs and boost efficiency for businesses. That makes justifying the cost a lot easier, especially if it's saving a business more than the cost of the software. UiPath holds a dominant position in the RPA market, and they are coming in well ahead of the rest of the pack. Here's another big name you've definitely heard of before: Salesforce. This is a cloud-based software company specializing in customer relationship management, or CRM. Salesforce helps companies manage and make the most of their relationships with customers across sales, marketing, customer service, and other business functions. However, they have gone well above and beyond just offering a CRM. They now offer cloud-based solutions for sales, services, marketing, e-commerce, and more. Notably, in the AI realm, they offer a tool called Einstein AI, a set of AI-based technologies designed to integrate directly with their flagship CRM product. Among other things, Einstein AI is capable of creating predictive customer journeys as well as designing personalized customer experience paths. Since inception, Salesforce's revenue has consistently grown to remarkable heights. They have also demonstrated remarkable improvement in both operating cash flow and net income over the past year. The balance sheet is in a robust state, boasting $14.2 billion in cash and investments, contrasted with a debt level of approximately $8.5 $2.4 billion. In addition, Salesforce consistently grows its capabilities through acquisitions like Slack, demonstrating their highly effective use of investment capital. Next up, we have a smaller company you likely haven't heard of before called Talkspace. Talkspace is a leading online therapy platform that provides accessible and affordable mental health care services. They revolutionized access to mental health care, offering therapy and other mental health support via text, live chat, and video sessions with licensed therapists. As far as the artificial intelligence component, Talkspace uses AI for therapist matching, suicide risk detection, monitoring patient progress, offering therapist support, and personalizing content recommendations. Talkspace offers a cost-effective alternative to traditional therapy, particularly for those lacking insurance. They also partner directly with employers and health insurance companies to extend mental health benefits to workers and policyholders. Now, following a tumultuous period marked by the CEO's departure, declining revenue, and significant operating losses, Talkspace has managed to realign and is now on the path to profitability for the first time ever in 2024. The balance sheet reveals that the company is in a strong position with $142.2 million in current assets against just $23.6 million in current liabilities. The global pandemic has fast-tracked telehealth adoption, especially among millennials, and this is a trend that is expected to persist, especially in mental health. Lastly, our analyst pointed out that the company possesses qualities that make it a prime candidate for acquisition by a major healthcare entity. If you frequently travel by plane, you've definitely seen the next company on our list in action, and that is SKYROCKET. This innovative company specializes in providing secure identity verification services through its Clear platform. Their business revolves around using biometrics like fingerprints and iris scans to swiftly and accurately verify identities. This technology is primarily used in airports to expedite security checks, but it's also applied in other venues such as stadiums and for various uses including health pass verifications. But another interesting product that they offer is Clear Verified, a business-to-business offering that extends the secure identity platform to partners for creating friction-free customer experiences. Services like this can be used for companies required to follow KYC or Know Your Customer laws. In addition, Atlas Certified is an automated solution for verifying professional licenses and certifying data across various industries. Over the past 2 quarters, the company's income statement has shown notable improvement, positioning it back on the path to profitability. ClearSecure recently enhanced its buyback program by $100 million, retiring $84.9 million worth of shares in Q1 of 2024, equating to 6% of its market cap. Up next, we have Cisco. Cisco Systems is a technology giant specializing in networking hardware, software, and services. Their core competency lies in building the infrastructure that powers the internet and enables connectivity for businesses and organizations worldwide. From data centers to firewalls and even VPNs, Cisco nearly does it all. Typical customers for Cisco Systems are businesses large and small, telecommunication companies and internet service providers, as well as schools, universities, and government agencies. Cisco is generating consistent revenue, with its income now being stable and predictable. In the last quarter, it reported $16 billion in operating income and approximately $13.4 billion in net income. However, it's worth noting that Cisco is not currently experiencing a high rate of growth. Instead, the company is focusing on strategic acquisitions to enhance its revenue, with the recent purchase of Splunk being a prime example. Looking at the balance sheet, Cisco demonstrates financial prudence, maintaining a manageable debt level. Next up, we have a company that many have probably interacted with at various points in our lives, and that is Match Group. They own and operate a vast portfolio of dating apps and websites. To name the most popular, Match Group owns Tinder, Hinge, OkCupid, Match.com, Plenty of Fish, and more. AI is being rapidly deployed across dating apps to improve matches and drive more user engagement. Match Group has experienced some challenging quarters in the past, with stagnant revenue and fluctuating net income. Nonetheless, the company appears to be returning to a growth phase, albeit at a modest single-digit rate, but the uptick in earnings has yet to be mirrored in the company's stock price. Match Group's quick ratio is at 2.2 and its current ratio is 2.39, indicating indicating that the company's liquidity position is adequate. However, they do have a sizable amount of long-term debt, coming in at $3.8 billion. The debt repayment is spread out until 2031. They've had to deploy a lot of cash in the past to build this broad portfolio of different dating apps. The last stock on our list before we get into the 3 watch list stocks flagged by our analyst is 3M. 3M is a multinational conglomerate known for its wide-ranging services both in the United States and internationally. The company operates through 4 primary segments: safety and industrial, transportation and electronics, healthcare, and consumer. The income statement reveals consistent revenue, yet there's a noticeable decrease in net income. This decline is significantly attributed to litigation expenses related to the military earplugs and environmental liabilities concerning PFAS chemicals. However, these should be shorter-term headwinds. 3M is utilizing AI as well as deep learning to optimize and improve their health information systems. Overall, 3M has maintained a strong balance sheet as well, boasting significant operating cash flow of $6.6 billion. Ratio analysis indicates that 3M is valued more attractively than competitors like Honeywell and General Electric, as well as the sector benchmark overall. Despite an anticipated lack of revenue growth in the near term, 3M presents itself as a compelling value opportunity. In addition, 3M is among the highly coveted list of dividend aristocrats, meaning they have both paid and grown their dividend every single year consecutively for 25 years or more. The last section here is going to be the 3 watch list stocks that were flagged by our analyst. These companies have interesting prospects, especially through the lens of AI. However, the analyst felt that these were either overvalued or fairly valued at this point in time. Nonetheless, they might be worth keeping an eye on, especially if there is a pullback in that share price. The first watch list stock is Mobileye Global, and this company develops and deploys advanced driver assistance systems and autonomous driving technologies and solutions worldwide. Our analyst felt this stock was overvalued by about 32%, but nonetheless, the growth prospects for autonomous driving remain rather interesting. Next up, we have a company that many of us are familiar with and utilizing every single day, and that is Adobe. Currently fairly valued by the market in the eyes of our analyst, it presents a reliable source of steady high single-digit returns, though it's not poised for any substantial growth in the near term. Adobe has been successful at pivoting away from their individual licensing business model to a subscription business model. However, all of that has already been priced into today's share price. In terms of the artificial intelligence component, Adobe is rolling out AI across numerous products, ranging from image generation using prompts to AI assistants that make design and even research work much simpler and far more user-friendly. And finally, we have Palantir Technologies, which is a very interesting company, but our analyst felt it was currently overvalued by about 40%. Palantir specializes in software platforms that are designed for big data analysis. With customers ranging from Fortune 500 companies to massive government organizations, Palantir should have a plethora of healthy revenue streams going forward. However, they have become a hot stock, and the share price has gone up quite a bit in recent times. Now, if you guys made it to the very end of this video, please make sure to drop a like as well as subscribe and hit the bell for future notifications, and leave me a comment down below if you'd like to see another video like this leveraging our financial analyst for the research. In addition, let me know down below if you own any of the stocks that were mentioned in this video. If you agree with our analyst or disagree, I would love to get the discussion started down below. You can click below to watch my video about Fidelity Index funds for beginners, and I hope to see you there.